Good morning guys, we're gonna continue today with buy and hold strategies and get more into the numbers. This is a continuation from my last week's video on buy and hold. If you like that content, as usual, you know what to do. I'm not gonna say it again, and let's go with the video. Hope you guys enjoy it.
Okay, there's a very good app. It's called Deal Check and it's free. You can download it on your phone. And I have here that property and I'm gonna give you some of the metrics here. So what else you need to add into that? We got home inspection, appraisal, loan points if you're getting any, lender fees, title escrow, attorney fees, transfer taxes if you have any. In my case, I just have here home inspection $300, appraisal $5,500, and that's that. After I've got rehab costs if the house needs any repairs. For example, on that property, no repairs were needed at all. I did put later on here $10,600, which is the roof and exterior siding that would have need to be repaired. And I added the HVAC system that we changed for, I think it was $4,000 if I remember correctly. But I added that later on after I bought it. But you need to account for those things. After the appraisal comes in, you need to see how many things need to be changed and account for that.
Okay, I actually found the receipt and it turns out the roof was almost as I expected. I expected 5,000 or projected 5,000 and it was 5,500. But for the HVAC system, surprise surprise, price was almost double. We spent 68.50 and I projected 3,500. I mean, things came up that I didn't see, you know, the ducting on the inside, I didn't see that. But this is what I actually ended up spending. That shouldn't trouble you in any way. Sometimes you miss stuff, sometimes you overestimate, sometimes you underestimate. But let's continue with the gross rent and the other numbers.
Gross rent, 3,500. Now we got vacancy, which I put on 0 because it was rented, but you need to account for vacancy. Good rule of thumb is 5 to 10%. And we got operating expenses, which is property taxes, insurance. Now I personally don't have the rest, but you might. Property management, maintenance, capital expenditures, HOA fees, utilities, landscaping. Now here all I have is property taxes. You can look them up on the clerk of courts, or what is the website actually? Property appraiser's website. You can look him up and see the taxes there, what has been taxed the year before, so you can assume it's somewhere around that number. Insurance, you can quote your guy if you have a guy. If not, you can, any company you call, they will give you a quote. Here we got appreciation, we got income increase, expense increase, selling costs, and you can, now if it's a long-term rental, you don't need to worry about those, but those are just projections that it's gonna, you know, it's gonna give you. Now at the end we have this, I'm gonna include here in the screen. We got the purchase price, 112.5. You got how much cash you need to close, and then the rest are kind of things that you shouldn't be very interested in. It's everything we filled in so far. And you got the cash flow. This is maybe one of the most important things, the cash flow. You got the cap rate, which you can see is more than 8%. Cash on cash return shows is a 15%. I guess it takes into account the other added things that we put. The ROI, the IRR, which we're gonna talk in the future. Now gross rent multiplier, that's usually for commercial property, you know, multiplex, fourplex, fiveplex, so on and so forth. And the rest of the things I don't think you need to care about. As you can see at the bottom, purchase price less than 25K, passes 50% rule, which is great, and passes cash flow greater than $150, which is good, but this criteria can be edited. What else can we see here? This basically shows you a projection for year 1, year 2, year 3. Oh, I clicked on year 35, but you get the point. Property tax is going to increase, insurance will increase, if you have HOA will increase, property management usually it's a percentage, so it's going to increase number wise but not percentage wise. And here you got the operating income for the year, operating expenses for the year, and you got the NOI, which is net operating income. This is important for you to know when you see and hear NOI. Okay, cash flow, that's per year, and then actually takes taxes out of it, which I didn't even know that it does that. Tax benefits and deductions, I mean, this app you can play with it long time, honestly. But those are some of the things you need to look at when you assessing a property. Obviously, you want a discount. Trust me, if the property sells below market value, it will be a good deal, even if you don't know all of that mathematics. Now, some people go and say, hey, I want my property to be cash flowing at least $300 because after I add PTIT or TIMR, which is PTIT is principal, interest, taxes, and insurance. So some people want their property to cash flow, for example, at least $300. There's something called TIMR, which is taxes, insurance, management, maintenance, emergencies, and reserves. And after all that, from that $300, basically they're gonna shrink down to say 150 or 125. So people want either $300 gross cash flow, or at least maybe 100 or 150, whatever your criteria is, of net cash flow. For example, on my property, what is the cash flow right now? We're looking at 1035 minus 730. So 305 is cash flowing right now. So from that $300, I need to include, this PTIT is included already. Principal, interest, taxes, and insurance is already included in that 730 that I pay for mortgage. But management, maintenance, emergencies, and reserves are not. I don't have management. Maintenance, you need to include, there's different ways to go about it. Some say $100 a month per property. Some say, 0.1% of the purchase price, which on a $100,000 property, 0.1% is also $100. But if you buy $200,000 property, then it's going to be different. So, maybe we're going to talk in depth about this in the future. But all in all, this is buy and hold, and the best tax benefit is you can depreciate the property over 27.5 years. I'm sure now because I just checked it. 27.5 years is 3.63% each year the property depreciates, which means, say you buy a property for $275,000, and this number is on purpose, so we can divide it by 27.5, which means each year the property will depreciate with 1/27.5. Which means each year you get your taxes and you tell the government, I lost $10,000 due to property depreciation. This is paper property depreciation. That doesn't mean that the property actually does not cost $275K anymore. No, most likely the property costs $290K now or $300. But because the government wants to incentivize investors to buy properties and provide those properties would provide housing for the public, they need to give us incentive to do so. And this is one of their incentives. You can depreciate the property over 27.5 years, which is good and bad. I personally would prefer to be depreciated over less amount of time, so I can depreciate more. For example, if you have a car, you can depreciate it in 5 years. Or an ATM, in my ATM business, it's 5 years. And everything has a depreciation schedule. Roof has 20 years depreciation lifetime. And on a further inspection, that was a lie. Roof actually has 27.5 years depreciation schedule life on residential and 39 years on commercial. So don't trust anything I say, guys. I double checked it. Those are the real numbers. I think stove has 5, refrigerator has 5, HVAC, I think it's 10, I'm not 100% sure on that. But you can check the schedule. Every item has a, microwave, everything has a schedule of how long it takes you to depreciate it. So if you buy a refrigerator for your property, this is a tax write-off. But I'm sorry about that. But you're not going to depreciate the full amount the first year. You're going to depreciate it over 5 years. Now, some items allow for accelerated depreciation, which means you can depreciate the full amount or more than the amount that they allow you the first year. For example, when you buy a different example, but when you buy a business vehicle for say $50,000 and you can depreciate it $10,000 each year, or $50K year one, or you can depreciate $30,000 the first year and then equal amounts year 2, 3, 4, and 5. But then we gotta look at depreciation recapture, so that's a topic for another video for another business. All in all, this is it. The idea when you buy a buy and hold property is to have cash flow, which is more passive than active. Maybe if you hire a managing company, they usually charge somewhere between 5 and 10% of the gross rent, which means on $1,000 rent, If you pay them 10%, you're paying them $100 a month to maintain everything, which doesn't mean they're gonna pay for the maintenance. They're just gonna go invoice you for the maintenance. You're gonna pay them, they're gonna call the plumber, the roofer, the HVAC guy, the AC guy, and they're gonna do the job and quote you that price. Basically, you don't need to be there and do those calls. Also, they find the tenants, they vet the tenants, and obviously they want tenants that pay on time and never get evicted, because that's more hassle for them. Benefit for taxes is, like I said, the property will paper depreciate 27.5 years. Bonuses on appreciation, market appreciation of the property. Ghetto properties, maybe 1% a year. High-end properties, 8, 9, 10, it depends. They appreciate the most. Mid-tier properties, 5-7%, somewhere in the middle. Rent, ghetto properties, high rent. Top-tier properties or high-income properties, lower rent, percentage-wise. Middle of the road properties, middle of the road rent. This is my niche, this is what I'm focused on. Okay, if you guys have any questions, please leave them down below. If I did not explain something the correct way, please let me know. Thank you very much for sticking to the end of the video. I see this one is a long one, but you need to lay the groundwork. We're gonna talk more about that buy and hold strategy. Thank you very much. If you already liked the video, if you haven't, like the video, bro. Keep hustling, guys, and I'll see you next Friday for my real estate video, where we're gonna talk about fix and flip. Then the Friday after, we're gonna talk about hard money, and we're gonna wrap all 4 methods in a little bit more depth. And hope you guys enjoyed those videos. Start today, start looking for properties, invest in your future, and start creating your wealth. Keep hustling. See you next time.